Hello, traders. It's Wednesday, and as usually on Wednesday at this time, I have a session about Opos, my trading strategy, which I call an afterwork strategy. It's based on pending orders, and it's also based on supply and demand zones. I show this session, this strategy every Wednesday. I show samples of trades I'm doing based on this strategy. And why I say it's a strategy for working people, because you must sit before the computer while you, even you have not much time, you can spend maybe 1, 2, 3 hours per day, and you can place pending orders which will be executed while you are at work. For an example, if let's say that you are a taxi driver and you work from 8 morning to 4 o'clock afternoon. Uh, this is the time when the market is most volatile, most interesting, but you have to work. So you will say, "Oh, I would open a trade here, but I was at work, I couldn't do it." Now, if you um, master the strategy, you will see that even if you're at work, your trades could be executed. You just put a pending order in the evenings and hope that it will be working after while you are at work. Of course, it's for all people who work, who don't have much time. I call it extra work, or let's say a hobby even, because you mustn't spend so much time before the charts. How it works? Well, it works. It's based on mainly on supply and demand zones. As you know, market is usually moving because it's there are some more buyers or more sellers, and they make the market move. It means that the fact that price is moving, it's not a miracle, it's not nothing unexpected. It's just something which is the effect of the fact that there are more buyers or sellers, or as we say, more investors who want to possess something, or those who want to get rid of it, just sell it. We observe this also not only on the financial markets, it works everywhere. You can see this chart which showing how the price of oil is changing, not because it's a different quality, it's because there's more demand or more supply. You remember when we had the pandemic and price of oil was falling lower and lower, because the demand was very, very low. People were staying at home. People didn't uh, drive cars, didn't travel, and the demand for oil was it literally plumped significantly. And still the production was on high levels, so all the inventories were full. The tankers were on the sea; they were not uh, unloaded because there was no customers for that, and price of oil was about $3 or $4 per barrel. And now we observe this is the time when the war began between Russia and Ukraine, when there was a risk that the pipelines which are running to the Ukraine will be blocked or destroyed. So price went to 130. Now we observe a similar situation because of the Strait of Hormuz is closed. A risk of low supply makes the demand pay more to get the oil. So as you see, the same product, but such a different price. What makes the price move? The fact that there was low demand and there's a high supply. And this happens also on Black Friday. When you go to the shops on Black Friday, the shops, they empty their warehouses, they reduced price just to get rid of this what they have, because they have to make space for another new collections. And when the supply exceeds the demand, it means that both shops want to sell more than the customers want to buy. The product becomes cheaper and cheaper to encourage buyers. Myself also, when I went to the shop and I say, "Wow, this shirt is so cheap." Normally, I wouldn't buy it because I didn't need it, but when I see such a low price, I say, "Okay, I'll take it home." And it's still not used, but because it was cheap, I got it. And this could be used also in our trading. In our trading, we are using supply and demand areas where the market started moving. You must remember how the zones are created. Big banks, big institutions, they deal usually with huge amount of money, and they cannot execute the order at once, because if someone goes to a let's say to a market and says, I'll buy all what's here, then of course the price is going up, because people say, oh, there's someone who wants to buy my goods, I can go up with the price, he'll probably also take it. And that's why those who want to buy something or want to sell something, they will not do it at once. They will divide their orders to small pieces. We call those all the order blocks. And it's very important to identify properly those areas, because in future it could be a good place to put your order, your pending order. For an example, this is a simple chart where I marked one level. This is a support and resistance level. And now there's a question, where are those supply and demand zones? Of course, we can see that probably somewhere here we have an area where market started falling rapidly. So probably here we can have a place, an area where the market is selling. Let me just open this. Okay. Oh, let me clean it. This is just a test. Okay, so probably here we have an area from where the market started selling. So there are people who want to sell. They started selling here, but look, the price ran away very quickly. So they couldn't sell anymore because they were interested in this price, not that price. That's why part of the orders are still waiting to be executed. The same happens with this area here. We have someone who started buying, and price ran away very quickly. So probably part of his orders are still not executed. So he started buying here. He maybe bought here, but here the price was too high. So he is still waiting to buy again. And that's why this we call a demand zone, and this is a supply zone. How we use it in our trading? Well, I'm using an indicator which is doing the work for me. And this indicator is drawing those zones. Those are the zones here. And how I'm using it? Well, the first thing I have to identify which zone is the strongest. Which is the strongest? Of course, the strongest zones are those from where the price is moving strongly. So for sure, this is a strong zone. This might be even a stronger zone. So usually the zones which are on the top of the screen or the bottom of the screen, those are the strongest. So when price is going up, I believe that the way the zone was created is very important. As for an example, if you see a V-shape price reaction, it means that the sellers are strong. If this is only something like this, I say that this supply zone is not so important. This is much stronger. And of course, this one is also a strong one, because the way the market left the zone is very, very dynamic. And that's the main idea of the strategy. If you have those zones, you need to identify them properly and say, oh, those are stronger, those are weaker, and you can put your pending orders. Pending orders means you can put a sell limit, for an example, here. So even if you're at work and the price comes to that level, then probably there will be a reaction. So you just put your stop loss above the zone, put your take profit, you should put around the last top. So you can say that this will be my take profit. Some zones which you see, which are already tested, and there it was one test, second test, and they might not keep anymore because there'll be maybe no more money here. Then probably it will be broken. So sell stop in case the price goes down will be in the trade. It very often happens that a broken zone, when the zone is broken, the price goes to another zone. So you can say this will be my take profit. It's a very simple strategy. You mustn't spend much time on it. You can just You can just sit without any nerves, without any emotions, because you plan your trades in front. I use this strategy also while there are some narrow consolidations. So, for an example, if you have a narrow consolidation, what means narrow? It means up to 40 pips maybe. And for an example, you are expecting some important news, maybe a Fed decision or a bank decision, other bank decision. On tomorrow, Thursday, we have the European Central Bank decision. So maybe this could be used, this strategy. Let's say that before the ECB decision, market Euro USD will be moving in a range. You can put two orders. You can put a buy stop, you can put a sell stop, and just wait for the breakout. When the breakout happens, then you can join the market without doing anything. Because let's say that you're at work. Tomorrow's ECB decision is at, I don't remember correctly. Let's say that it is 14 o'clock or 14:15. And you're at work now, so you cannot sit before the computer and watch it. So you can put your two orders and just wait for the result. And let's say that that the ECB will rise the rates. Wow, the euro will get stronger. Boom, they go up, and so your buy stop will be activated. Either if the things go wrong and they go down, your sell stop will be activated. So that's also the way you can use this strategy while you are at work. So now I'll show you some samples. Let's go to the charts and let's start with maybe with pound, because I opened a short position on pound. I was showing not long ago this chart here. This is what I made just half an hour ago. I was drawing this. Here we have a flag. This is a kind of a flag. This is kind of a bearish channel, bullish channel, but it's a bearish flag, and I expect some declines. And as you see here, we have the demand zone. Maybe I'll write it down. It's a demand. So why I expect the market, and why? Where is my take profit? My take profit is above the demand zone. This is my take profit, because this demand zone wait already twice. It might wait maybe once more, but you never know. But anyway, this looks like that. Here we had a bullish price action. This zone was created, and look what happens later on the same demand zone that's again tested. So maybe something like this might happen here. So when I'm selling, my target is around the closest demand zone. I don't plan any take profits beyond the demand zone, because beyond the demand zones, maybe later, maybe after some corrections here, but probably if market falls here, this will be, the market will stop and there might be a reaction. There might be a reaction. What's important when you identify a zone as a strong one or a weak one? This is what I said. The way the market is moving, if it's in a very short time on the zone and moves higher quickly, look how big candle we had here. It means that this is a strong zone. And look what happens later. They just touch the zone and again they move up. So this reaction here is also not bad. We could see this reaction was also a V shape. So maybe we can see also something like this here. So that's why when I open a short position, I close it. My target is around the demand zone. This is my way of take profit, stop losses, and so on. And that's it. So as you see, the zones are very helpful, and you can use them. What also I would like to show you the chart I was posting half an hour ago. I put a question mark here because look, the MACD was still bullish, and I put a question mark thinking that if they break out from the flag, will the MACD change to bearish? Because if it will change to bearish, it will be probably a good entry. And look what happens. MACD went bearish, so it makes me comfortable, because not only there's a breakout from a flag, but also the MACD follows the breakout. So we can say that MACD is a kind of proof or confirmation